As of 11:40 a.m. Eastern Time on November 12, 2025, shares of Nuburu Inc., ticker BURU, are trading live at $0.27. That is a sharp move up, currently 5.55% in the green for the day. Volume is already heavy at over 28 million shares, with the stock oscillating in a tight, volatile range between $0.2658 and $0.2904. Now, many investors looking at that green candle today might feel a sense of relief, or perhaps even opportunity in what has been a brutal chart. But the immediate price action is not the real story. The expectation that has been sold to the market is that Nuburu is a cutting-edge pioneer in blue laser technology. The reality, when you look beneath the hood, is that this company is undergoing a radical, high-stakes transformation while simultaneously facing existential financial pressures. What you think this company is, and what it is desperately trying to become, are two very different things. Let's establish the common ground, the narrative most people bought into. Nuburu was presented as a pure play on the future of advanced manufacturing. Its core technology, high-power blue lasers, solves a very real problem. Traditional infrared lasers struggle to weld or 3D print reflective metals like copper, aluminum, and nickel. Blue light is absorbed far more efficiently, allowing for defect-free welds. This is not a trivial matter. It's a critical component for manufacturing next-generation EV batteries, intricate electronics, and advanced aerospace parts. This was the story. A company providing a key enabling technology for the biggest industrial trends of the next decade. But that expectation is now crashing into a very harsh reality. That tidy engineering-focused narrative has been completely eclipsed by a financial and strategic crisis. The company's own filings have raised substantial doubt about its ability to continue as a going concern without securing new funding. As of their last major report, the company was operating with a dangerously low cash balance and a staggering accumulated deficit. To survive, the company has been relying on a standby equity purchase agreement, which has led to absolutely massive shareholder dilution over the past year. We're talking total shares outstanding growing by over 1,700%. This is the kind of dilution that can crush a stock's value, regardless of the underlying technology. The daily price swings you are seeing now, like today's 5% pop, are not about blue lasers. They are about survival. The company's recent announcements paint a picture of a management team throwing everything at the wall to see what sticks. Nuburu has announced a transformation plan, and it's not just a minor adjustment. They are pivoting hard, almost unrecognizably, into a unified defense tech platform. This includes forming a subsidiary, Nuburu Defense, and announcing plans to acquire a 10.7% stake in an Italian software firm called Orbit SRL, which specializes in operational resilience and crisis management. They also announced a strategic alliance with Maddox Defense to form a joint venture for military drones, and a renewed partnership with TechniForge, again targeting defense and NATO cooperation. This is the tension at the heart of BURU. The market expectation was for a high-growth, specialized industrial tech company. The reality is a cash-starved firm that is attempting a complex and frankly confusing pivot into the defense and software sector, an area where it has no established track record. These acquisitions and joint ventures, announced one after another, have triggered massive spikes in volume. We saw the stock soar in October on the initial news, only to collapse just as quickly. This is no longer an investment. It is a high-velocity speculation on whether this strategic gamble can pay off before the lights go out. So you might not know what I'm talking about, but this blue laser is very big. This brings us to the short sellers.
When a company has a story this disconnected from its financial fundamentals, it becomes a prime target. The current short float on BURU is sitting at a very high 15.47%. That is a significant portion of the public float betting that this stock is going lower. These short positions are not just a random guess, they are a calculated thesis. The short thesis is simple. The blue laser technology, while interesting, is not generating nearly enough revenue to cover the company's massive cash burn. They see the frantic pivot to defense as a desperate Hail Mary pass. They are betting that the dilution from equity agreements will continue to pressure the price downward, and that the company will ultimately fail to execute its new complex strategy. For retail investors, this creates a volatile battlefield. On forums and social media, you see the narrative split. One side sees a pump and dump, pointing to the 1,700% dilution and the stock's collapse from its 52-week high of near $1. The other side sees the 15.47% short interest and dreams of a short squeeze. So what's your take on the rising short interest? Smart money or manipulation? Comment below with your thoughts. This retail versus short dynamic is what's fueling the 30, 40, and 60 million share volume days. It is a tug of war between two extremes, and the company's fundamentals are almost an afterthought. So, how do you navigate this? First, you need to understand what to look for. Investors can track short interest data, which is typically updated twice a month, on platforms like Fintel or through their brokerage. But short interest percentage is only one piece of the puzzle. You also want to watch the borrow fee rate. This is the interest rate short sellers must pay to borrow the shares. If this rate spikes to triple-digit percentages, it indicates shares are becoming scarce and expensive to short, which can sometimes be a precursor to a squeeze. Also, watch the FTD data from the SEC. While complex, spikes in FTDs can sometimes indicate stress in the system. The actionable step here is not to blindly chase a squeeze. The reality is that squeezes are rare, violent, and almost impossible to time. A more responsible approach is to understand the risks. The short thesis has merit, based purely on the company's financial distress and going concern warning. The long thesis is no longer about blue lasers. It is a pure bet that this new defense strategy, acquiring software firms and drone ventures, will create a viable business from scratch, and do it fast enough to outrun the dilution. The fact that institutional ownership is vanishingly small at only around 1% of the company tells you everything you need to know. This is not a stock that large conservative funds are willing to touch. It is 94% owned by the general public, which is why it can be pushed around so easily by news and sentiment. Looking forward, the entire story hinges on execution and funding. The expectation is that these new defense ventures will generate revenue. The reality is that defense contracts are slow, complex, and highly competitive. Nuburu is entering this field as a brand new, tiny, and financially weak player. The company needs cash, and it needs it now. This means investors must brace for the high probability of more share offerings, more dilution, or perhaps a reverse stock price just to maintain its NYSE listing, as it has already received a warning letter from the exchange. The catalysts to watch are simple. First, any news on the financing front. Will they secure a large non-dilutive contract? Or will they announce another equity line of credit drawdown, sending more shares into the market? I want you to comment below with a simple yes or no. Do you believe Nuburu's pivot to defense will be successful? In summary, the story of Nuburu Inc. has become almost unrecognizable. The initial expectation of a specialized high-tech laser company has given way to the harsh reality of a company fighting for its financial life. The stock's wild swings are a direct reflection of this tension. It is a battle between a grim financial reality, a massive 15% short position, and a desperate, company-altering pivot into a new industry. Today's 5% gain is just noise within that larger conflict. The real test is whether this company can build an entirely new business on the fly before its massive dilution and cash burn consume it entirely.